Okay, the last video on bonds is selling at a premium. Why would we be able to sell our bonds at a premium, which means selling it for more than what the face value of the bond is? Well, if our bond out on the market is paying 5% interest and other bonds are paying less than that, 4, 3, 2, 1, whatever it is, then people are going to be willing to buy our bond because we are paying a higher interest rate. So in those particular cases, we can charge more for our bond than what the face value is worth. And so how do we figure out how much we record, how much cash we're going to receive? Because remember, we always record the bond payable at the face value of the bond, which in this case is $565,000. And if we read the problem, it says the company issued the bonds with a par value or face value of $565,000. The bond matures in 2 years and it pays a 5% interest rate on June 30th and December 31st. The annual market rate at the date of issuance is 4%, so that's why we're able to pay to get a premium. The bonds are sold for $575,731 or 101.8993%. So how do we get the dollar amount? We take the $565,000 of the face value and we multiply it times 101.8993%. And that gives us the $575,731. That's what they're actually going to pay us. Okay, so what is the amount of the premium? You just take the amount that they paid us and subtract the face value. So the premium is going to be $10,731. What's the amount of interest? Well, we are contractually obligated to pay the 5% that is stated on our bonds. So the $565,000 times 5%, but they're not going to get the full 5% each time we pay because we're paying it twice a year. So we have to multiply that times 1/2. So they're going to get $14,125 every June 30th and December 31st. That's the amount of interest that we're going to have to pay them. So what is the carrying value of the bond when we first recorded on our books? The bond payable is always going to be at the face value, and the premium is actually going to increase the carrying value. So this time we're going to add the two together instead of subtract them like we did with the discount. Can't talk and type at the same time, evidently. Okay, so that's the carrying value of our bond. So at the issuance of the bond, what is our journal entry going to be? Well, we know that we received the cash, what they actually paid us, the premium amount. So that's going to be a debit to cash, $575,731. We know where we're going to record the bonds payable at the face value because that's what it's always recorded at. The $565,000. It is a liability, so we have to credit it to increase it. And the premium on bonds payable is another new account, and it is an additional liability. So $10,731. Remember, your journal entries always have to be in balance. So the $575,731, we add these two together, it's going to equal our debits. So what is the journal entry we have to do on June 30th and December 31st every time we pay interest? Well, we're going to record bond interest expense. We know that. I'm not going to fill in the amount yet. We have to amortize this premium, just like we did with the discount on bonds payable. We have to now amortize the premium on bonds payable. And we have to pay them the interest amount, so our cash is going to be decreased. Our cash is going to be decreased by the $14,125, the amount we're legally obligated to pay them. That was the $565,000 times the 5% times 1/2. The premium on the bonds payable, the $10,731, we are going to have to amortize over the life of the bond. So $10,731. It's a 2-year bond, and we pay twice a year, so that's 4 interest periods. So I'm going to divide this $10,731 by 4 interest periods, because every time we make an interest payment, we're going to amortize that. So that's $2,600, and we're going to round it to the nearest dollar, $2,683. And that is going to be a debit, because remember, we recorded it initially as a credit, so in order to reduce it, we have to credit it. And then your debit is simply going to be the net of these two to make the journal entry balance. 14,125 minus the 2,683. Okay? So every time we make an interest payment, that is going to be our journal entry. You're not going to have to recalculate anything. That is simply going to be it. Every June 30th and December 31st for the next 2 years, that'll be the interest. That will be the journal entry that you make. So what is the carrying value of the bonds now? $565,000 is the bonds payable. That doesn't change throughout the life of the bond. The premium was originally $10,731, but we just reduced it by $2,683. So the carrying value of the bond now, if we add those two together, is $573,048. Okay? And then what journal entry do we do at the maturity of the bond? It's the same as it is with every other one, whether we issue it at par, a discount, or premium. You're always going to be taking that bond payable off your books, because now we are paying them back their principal. And we have to reduce our cash because we have to pay them that principal back. Okay, so that is the journal entry. Every single time you're going to take the bonds payable off the books by debiting it. It's a liability, so you have to debit it to decrease it. And that's always done at face value, no matter whether you sell it at par, a discount, or premium. And you're going to reduce your cash by the amount of the bond payable so that your journal entry is in balance. Okay?